Welcome back to the XRP Insider Network, your number one destination for XRP analysis, breaking developments, and insider level narratives you won't hear anywhere else. I'm glad you're here. If you haven't yet, make sure to smash that subscribe button and turn on notifications because today's video might just be one of the most important XRP breakdowns we've ever done. Here's the shock. Ripple's own CTO just said something that could send shockwaves through the entire crypto market. He said XRPs can't stay cheap. Not in some generic sense, but in a way that suggests major fundamental upside is now built into the network itself. Today, we're going to unpack what that means, why institutional traders are scooping up XRP, and whether a monetary per 100 price target is now realistic or even conservative. So let's dive in. First, let's set the stage. Ripple Labs, the company behind XRP, has spent years building out payment infrastructure that rivals Swift, Target2, FedNow, and even blockchain competitors. The CTO's comments didn't come in a vacuum. They came during a broader discussion about institutional demand, on-chain growth metrics, global partnerships, and network velocity. So, when a C-suite executive says XRP can't stay cheap, that's not commentary, it's insight. But before we go deeper, I want you to pause for a moment. If you're watching right now, hit like and subscribe, not just for this video, but for every single XRP insight we're going to drop this quarter. Trust me, you'll want to be here for what comes next. Here's the direct gist. Ripple's CTO essentially argued that the intrinsic utility of XRP, especially in cross-border liquidity and settlement, is growing at a rate that outpaces its current market valuation. That means the valuation we see today, which keeps XRP priced in the low double digits, sometimes even single digits, does not reflect the real economic use being built into the chain. This isn't marketing hype. It's a fundamental observation about utility versus price. And utility is what eventually drives price in sustainable markets. Here's the thing. When utility outpaces price, you don't just get volatility, you get structural valuation expansion. That's why the CTO's statement isn't something to brush off. It's a reflection of demand from payment providers, real transaction volume, institutional interest, and rising on-chain velocity. Each of these is a fundamental input into valuation. And if they're trending up faster than price, price is, by definition, too cheap. Today, we'll break down each one of these factors so you can see exactly why a $100 price target isn't just talk. It might be closer than most people realize. Let's talk institutions. Hedge funds, asset managers, and treasury desks don't buy crypto for memes. They buy based on risk, utility, and return expectations. XRP at scale offers 1. Deep liquidity, 2. Fast settlement, 3. A global Rails network, 4. Regulatory clarity through Ripple's active legal strategy. The CTO pointed out that institutions are increasingly viewing XRP as a settlement asset, not just a speculative token. That's huge because institutional demand operates on a different velocity curve than retail. They accumulate slowly, strategically, and with a long horizon. When a bank or payment provider integrates XRP for liquidity, they're not doing it because they think the price will moon next week. They're doing it because XRP solves a real cost problem. That's reoccurring revenue potential for Ripple and recurring settlement flows for the token itself. In short, adoption begets utility, utility begets valuation expansion. The CTO's comments also hinted at what the data is already showing. XRP's on-chain velocity is improving. That means tokens are moving faster from wallet to wallet between exchanges and through liquidity pools. This uptick is the sign of utilization, not speculation. And remember, price is a function of supply and demand. At current valuations, demand is rising while supply remains relatively fixed. That's a recipe economists and traders call upward valuation pressure. I know you're wondering, okay, so utility is rising, but where does that actually put XRP price? Some analysts are now openly talking about on $100 or more. For context, that's roughly a 20x move from current levels, a market cap comparable to legacy payment networks, and a valuation still far below the actual economic throughput Ripple's tech enables. It's not arbitrary on its math, and it's based on 1. Adoption rates, 2. Payment volume, 3. Institutional flows, 4. On-chain metrics, 5. And macro liquidity conditions. We'll unpack each of these in detail shortly, but let's pause for a moment and make sure you're subscribed because this next section digs into the real numbers behind the narrative and, and why some whales might already be positioning heavily in XRP right now. Let's start by understanding how institutional flows change a market. When a hedge fund or institutional desk acquires crypto, they don't flip it in hours, days, or even weeks. They accumulate over weeks and months, often quietly under the radar. Why? Because large orders move markets. This means when institutions accumulate XRP, price doesn't immediately spike. It grinds upward over time, creating a strong support base beneath every rally. And according to Ripple's CTO, institutional interest isn't hypothetical, it's real and increasing. So let's talk about the mechanisms. OTC desks are reporting larger XRP blocks. Custodial wallets are reporting growing institutional deposits. And trading volumes on regulated exchanges suggest more sustained accumulation versus quick churn. Those are subtle signals, but to a professional trader, they're screaming structural demand. Here's the crucial distinction. Speculation is price chasing price. Utility is price chasing real usage. Right now, XRP's network utility, especially in remittances and cross-border settlement, is climbing. That means real-world entities are using XRP as part of their operations. That's not hype, that's economic activity. If demand from actual use cases keeps outpacing speculative interest, price eventually has no choice but to reflect utility. That's just market dynamics 101. Another key piece often overlooked, Ripple isn't sitting idle in the regulatory arena. The legal clarity Ripple is pursuing, and in some cases obtaining, matters. Institutions don't like regulatory uncertainty. It's a risk factor that gets priced into valuations. The CTO's remarks implied that Ripple's legal strategy is yielding increasing confidence among big players. That confidence lowers barriers to entry, and as institutional barriers fall, a new wave of capital can flow into XRP. That's another reason why price holding low double digits while utility grows is an anomaly, and anomalies don't last. Let's break down on-chain velocity in simple terms. It's the rate at which tokens are being transacted across the network. Higher velocity means tokens are not just sitting idle, they're actively moving from user to user, they're used in settlement processes, and they're supporting real financial operations. The CTO suggested that velocity trends are outpacing price trends, which again suggests that price is lagging behind real usage. That's one of the most important signals any serious analyst can track. So where does this math lead? There are a few ways to model crypto valuations. 1. Network value to transactions. NVT compares network value to transaction volume. 2. Utility growth models. Estimates where price goes as usage expands. 3. Institutional flow models. Incorporates large player accumulation. When analysts run these models with current data, many are arriving at targets that do include 100 XRP and some even higher over longer horizons, not because of hype, because of utility growth and institutional demand. That's the real takeaway from the CTO's comments. Look, I'm not here to sell you a dream without reality. There are risks, regulatory uncertainty in certain jurisdictions, liquidity fluctuations, macro tightening, and competitor innovations. But if Ripple's utility continues to grow and institutions keep accumulating, those risks start to get priced into a higher valuation floor, not a lower one. That's what the CTO was really getting at when he said XRP can't stay cheap. Let's bring it all together. If utility is rising, institutions are accumulating, on-chain velocity is increasing, and regulatory clarity is improving, then price lagging utility isn't sustainable. Over time, price must catch up. And if price does catch up, based on real-world adoption rather than short-term speculation, then a $100 XRP price is not merely possible, it's mathematically plausible. And so that's the big picture. Thanks for watching. And if this breakdown opened your eyes, make sure you hit that subscribe button so you don't miss the next deep dive we have coming. We'll be back soon with more updates, data, and insight tailored for serious XRP believers and analysts like you.